Welcome to Francis Financial's first quarter market review and investment forecast. I'm Stacy Francis, and I'm going to be joined shortly with Avni Ramani, who is our Director of Financial Planning and Investment Management here at Francis Financial. We have a lot that we're going to be going through today, but before we do, I want to give you a very, very special invitation. We are going to be having a wonderful event called Wine, Not Talk About Money. And wine is actually spelled W-I-N-E. Why? Because we have some beautiful wines that we'll be enjoying as well as some sushi. And the topic is, what color is your retirement? Our event's going to be here at the Francis Financial offices Thursday, May 23rd from 6:30 p.m. to 9 o'clock. It's going to be women only, and it's a conversation circle. And if you haven't been part of one of these before, don't worry. It's something that is really unique, really special, and something that I know you're going to get a lot of. We're going to be talking together, all of us, about money, what our relationship with money looks like, and more importantly, as we move forward, helping you envision what you want your retirement to look like. And that is why that topic is, what color is your retirement? But without further ado, I want to go ahead and introduce my colleague, Avni Ramani, who's going to be taking you through the actual market movements that we saw this last quarter, as well as updates about what the rest of the year and beyond might look like. And then at the end, I'll come in with some interesting tips, some things to keep in mind as you weather this pretty choppy market. So without further ado, I'm introducing Avni Ramani, and thank you for being with us.
Hello, everyone. Welcome again. And as Stacy mentioned, we'll go through our first quarter market review today to start off with, and then we'll look at a couple of different topics that we'd love to discuss with you. So getting started, you may all remember how rough 2018 was. It was a tough year. Pretty much the second half of the year was quite difficult. All the asset classes in 2018 ended up being in the red. We saw losses in most of at least the stock side of the market. And this was caused by a lack of investor faith. There was a few discouraging signs, discouraging news in the market, and the emotions ran very, very high. But the underlying economy was still doing well, and we'll talk about that in a little while. As you can see here, it was hard for pretty much all asset classes. There was just nowhere to hide in stocks in the year 2018. 2019, the first quarter was different. We saw a huge comeback, which was just phenomenal to see. And all the assets were pretty much in the black. Every asset class made money and had such a great recovery that everything for the last 12 months or so came back in the positive territory. All asset classes had come back in the positive territory. So let's look at specifically what happened in U.S. stocks. If you could think back to 2018, everyone, many experts were saying, oh, we're almost there. This should be the top. The economy has been, the markets have been in an upswing for 10 years. And so, we've got to be at the top. And when they saw the negative news come out in the second half of 2018, they said, hey, we called it. This is where the market's going to stop growing and we're going into a recession. But guess what happened in Q1? In Q1, all these different asset classes on the stock side went up again. And had you got out of the market at the end of 2018, you would have really lost out on this huge jump that the market saw in the first quarter of 2019. So if you see here, this chart shows you what happened in the S&P 500 index in the first quarter of 2019. It was an amazing rebound from the fourth quarter, almost up 14%, 13.7%. It was the S&P 500 was up almost 14%, which is just a huge relief to the investors. A lot had to do with what the Federal Reserve was saying, and this is coming back to the economy. The Federal Reserve came out with a lot of different points of view for the market. And back in September, they hiked interest rates, signaling that, signaling at least to the market that they thought that the market was at a very high level and it needs to be reined back a little bit. But, and then the way the market reacted is that it dropped. And we've seen that consistently with every time the Federal Reserve comes out and hikes rates, the market took a little bit of a hit. Now, in January, the Federal Reserve Chair, Mr. Powell, said that the Fed will now be a little bit patient with rate increases. And whereas the experts had anticipated three increases during 2019, they said that we pretty much keep rates flat and may do just one or even none. So that was a huge relief for the economy, and the markets went up after that. So we should be thanking Mr. Powell for this recovery as well. Something else that happened was that towards the end of 2018, in the last couple of weeks in December, there was a government shutdown. It didn't last very long, but because of the negative news, the markets again got very emotional and went down. Now, in January, towards the end of January, the government reopened, which also gave a lot of hope to the U.S. stock markets. Now, with this uptick in the stocks, we do think that the U.S. large cap stocks are in a territory where they are a little bit overvalued and overpriced again. And we've been talking about this for a few quarters now, but at this point, dependent on the price to earning ratios, and as a reminder, price to earning ratios are the price that an investor is willing to pay for the amount of earnings that they expect the stock to make. So the price to earning ratios, if the ratios are high, it means that the investors are paying high for the amount of expected earnings. And if the ratios are low, it means that the investors are paying a low price for the amount of earnings expected. So when the price to earning ratios go high, our view is that investors are paying more than what the expected earnings should be. So that's not a good place to be. And we'll keep an eye. It's not signaling anything. These things go up and down, as you can see. But we're keeping an eye on that. And we do think that stocks are in the overvalued segment now. Let's move on to bonds. Now, as I mentioned before, Federal Reserve Chair Mr. Powell had signaled that these interest rates were they're going to put a little bit of a break in increasing interest rates, and that there might just be one more increase in the next 2 years. So that's great news for the market. Now, it's great news for the stock market, but what happens to bonds is that they have an inverse relationship, an opposite relationship with bond prices. When interest rates go up, bond prices go down. And the other way too, when interest rates go down, bond prices go up. So that's the relationship that bond prices have with interest rates. Now, because interest rates aren't rising as many had expected them to be, it's almost as if they fell. That's how the markets reacted. Therefore, we saw that bond prices increased during Q1. So bonds had a great first quarter as well in response to the news about interest rates not being increased. Let's now look at another side of the stock market, the international side. And the international stocks also performed really, really well in the first quarter. As you can see, across the globe, Canada was up 15.6%. The UK was up almost 12%. France, Russia, India, China, all international stock markets were up quite significantly in the first quarter. There were some emerging markets in here too, as I mentioned, and even the emerging markets were up in the first quarter. Overall, they were up almost 10%, 9.9% that these markets were up. And just similar contrast we saw with Q4. So remember Q4 when the emerging markets had such a rough year, pretty much everything except Qatar was down. And Qatar was the rock star in Q4 with a growth of 27%. And hypothetically, if we had moved all the investments to Qatar, guess what would have happened? Because we should remember that past performance is no guarantee for future results. We would have experienced a loss in the Qatar investments, and we would have missed out on all the gains that these other emerging market countries had experienced. Colombia has experienced almost a little more than 25% growth. And you see all these numbers here for China and Egypt, Greece, Russia. They're all in double digits. So we would have missed out on these phenomenal growths for emerging markets in Q1. And that's one thing that we keep saying about, how to have a diversified portfolio, not to have concentrated positions, not to try to anticipate what will happen in one market versus another, but have a diversified portfolio. Moving on to developed international, even that market, that segment had a great turnaround. On the left, you see the numbers for 2018 and all those reds that you see, because 2018 was a rough year. But again, 2019 had a great start with many, many double digits that we see here in terms of growth percentages. And pretty much all markets had a phenomenal comeback in this segment as well. So, great news. This is based on some good news around the trade talks with China, the whole Brexit situation that is being faced over there. The hard Brexit seemed to just wane, and all this positive news lifted up the markets, developed international markets, as well as emerging markets such as China. So now we go back to the question that many of us were asking in Q3 and Q4, are international stocks still a good deal? And we are giving international stocks a thumbs up. We still strongly believe in international stocks and that they are a good investment, both relatively speaking and historically speaking. So all the indications of PE ratios from Europe and emerging markets are indicating that these markets have a potential for growth. Their price to earning ratios are indicating that there's still a lot of growth left in the market, and therefore we still believe very, very strongly that these are a great investment. Um, Again, as a reminder, P/E ratios show how much investors are willing to pay per dollar of earnings of the companies that they're looking to invest in. So yes, it is. International stocks are still priced well, and it is a buying opportunity. Now, let's take a little step back and talk about um, just comparing our portfolio to other indices. And one question that we get from clients is, what is my portfolio doing compared to the Dow or S&P 500 or whatever other benchmark that somebody might use? But in the popular media, the Dow is one of the big indices that is talked about, as also is the S&P 500. So we figured let's just do a little bit digging into what is the Dow Jones Index. The Dow Jones Index is comprised of 30 stocks. Yes, it is only 30 stocks amongst all the stocks that are available on the stock market. So these are just 30 stocks that are the largest companies in the US. Many of the names that you're familiar with, like Coca-Cola, Microsoft, 3M, Pfizer, P&G. So companies that we are all pretty familiar with, these form the Dow Jones Index. So whatever the stock price of these companies do, they go into the collective Dow Jones Index. Now, S&P 500 is another index that is pretty popular, as it should be. These are the top 500 companies in the US. And again, you'll see some familiar, these are ticker symbols, but again, you'll see Google, Facebook, Microsoft, Amazon, Apple, Bank of America, there's just all these familiar, JP Morgan, all these familiar companies. And S&P 500 is, again, it's the top 500 stocks in the United States, but again, it's just focused to stocks. So when we talk about comparing one of these indexes to your portfolio, it's not really a good comparison. It's like comparing apples to oranges. And the reason being is that your portfolio is comprised not just of stocks, not just of US stocks, but also international, developed international stocks, of emerging market stocks, and bonds. So we usually, people in the popular media will have you believe that benchmarking your portfolio against an S&P 500 index is the way to go. But we urge you to think about everything that your portfolio is made up of, and that how it's not a good comparison to make with a pure stock index, such as the S&P 500 and the Dow Jones Index. These are familiar images from the popular media. We see every time an index takes a hit, we see red flashing signs and, tape running across your screen and people looking upset and disturbed with what's happening on their screens. And these are just images that make you feel like there is something really terrible going on. There's a crisis. But you have to remember that if the stock market or one of the stock indexes, such as the Dow Jones, falls, it just means that those 30 companies, the prices in those 30 companies have fallen. It does not give any indication of what's happening in the bonds side of your portfolio or the international investments that are in your portfolio. Now, when you have to remember, what are the headlines telling us and what is the reality on the ground? And when they talk about movements in the Dow Jones Index, for example, they're communicating in units known as points, and to signify how much the Dow has increased or fallen. But we need for investors to be cautious when trying to understand what these headlines mean, because a movement of 500 points up or down really is not as meaningful as it used to be way back in 1985, 1986, 1987, because the index itself was very small. So a 500-point increase or decrease meant a much larger percentage than it does today. So, just use that piece of information as background when you consume these headlines, and know that there's a lot of sensationalism going on in the press to catch your attention, to grab those eyeballs. Other important indices, we talked about the S&P 500. There's indices by MSCI for developed markets as well as emerging markets. Russell indexes, they are by Russell Investments, and they bring out some indexes as well, covering different segments of the market. So there are many indexes out there, many indices out there that you should be looking at and try to bring it all together to understand how the portfolio is doing against just what the market is doing in general. I would like to invite Stacy back to go through the next part of the presentation. Thank you for listening, and we hope to talk soon.
Welcome. Now we're going to be talking a little bit about how do you deal with the ups and downs. The one thing I think that came through very, very clearly as Avni was talking you through the fourth quarter, and then for 2019, the first quarter, how much change there has been. Things looked pretty dismal and pretty, well, downright depressing in the fourth quarter of 2018. Look at us now, only a few months later. And in 2019, we've had some of the best performance that we've seen in a decade. How things can change. And the challenge is that you can be your own best friend, or you can be your own worst enemy. In an environment like this, it's no doubt that investing is emotional, because in investing, you either are earning, gaining money, or in down markets like we saw in the fourth quarter of 2018, potentially losing money. And I don't know about you, but seeing money go out of your portfolio is not something that any of us are really excited about or feel comfortable with. However, I have to tell you, though, that too often, we trust our emotions, and we call it our gut. Your gut feeling cannot be separated from your emotions. So when you're trusting your gut, you're really just managing and moving and having action based on your emotions. And this is a really cute cartoon that we found that I thought would really sum up all of this. And the gentleman behind the desk is saying, it would appear, Hopkins, that your gut feeling was only indigestion. And the picture that you can see before, right on top of that desk, is essentially his portfolio and how the portfolio has gone down and down and down. So as we talk about not dealing with, not being swayed by our emotions, the best way to tackle that is to understand when we are most emotional. So something you can see here, this is a typical time period where the market is going up, you can see, and then it's coming back down. And a good time period to liken this to was back in 1999. Back in 1990, early 2000s, we saw, if you recall, the internet bubble. And as we traveled and the value and price of stocks continued to climb, more and more people felt confident about putting money in the market. So much so that at the very top of the bubble was when we started to see the largest amount of assets, of money flowing into the market. And that's when stocks were trading at absolute all-time highs. But everyone, and I don't want to say, I guess everyone, but the majority of individuals were very euphoric, very excited. People were making money hand over foot. Seemed like it was easy. And if you weren't putting all of your life savings in technology stocks, well, you weren't being very smart. And that's what a lot of people unfortunately did. They kept on adding money, a lot of money that they actually couldn't lose. And they did it more so at the very top of the market before we started to see that bubble burst. And as the bubble burst, people became nervous. They became desperate. And once we hit our bottom, they became defeated. And that's when they did the worst possible thing. And what was that? They took their money out of the market. So that shows you the life cycle of the market of going up and down, but also the emotions that can cause us to make bad decisions. And what I'm going to do now is uncover for you the 5 traps, the 5 pieces where we see people making the biggest mistakes. And the first one is impulsive decisions. And, I was thinking about this, and I feel like I have a perfect example in this picture. Here's a woman who is, buying a book, and it's very cute, How to Stop Impulsive Buying. She's saying, I just got to buy this. So I will give you an example of impulsive decisions. Impulsive decisions are when someone like myself, I put the kids to bed, I pour myself a glass of wine, and I reflect on my day. And if I haven't had a very easy day, sometimes I'll think about visiting Zappos. So don't judge me, because maybe you have a Zappos issue too. But I know that if I have my glass of wine, I've had a tough day, and I go on Zappos, I'm going to do what? I'm going to impulse buy, because maybe I'm not feeling so good. A new pair of shoes always makes me feel better. But you bet by the time they get delivered to me and I try them on, I have a big feeling of regret. And we see this, interestingly enough, the same behavior with stocks, with investments. Maybe you went to a cocktail party, someone was talking with a friend, and they seem very smart, and they, just invested in XYZ, or maybe they decided to pull all their money out. Maybe you read an article in CNBC. And so you decide to make a decision, potentially make a change in your portfolio. So just as I do with my shoe addiction, I make sure that I sleep on it, that I think about all the different options of how to make myself feel better other than just buying shoes. And for you, what I invite you to do too is to sleep on it and reach out to your financial advisor and to talk about, is this a good option for me? It might be a great option for my friend, but is it actually a good option for me? All right, number 2. The number 2, taking undue risk. What I think is interesting about this is that a lot of individuals try to avoid risk, when in reality, they end up putting themselves in harm's way, actually jeopardizing their financial security. Let me give you this example. So we see many portfolios coming to us for a second opinion. And this is a service that we provide free of charge to look at how are you currently invested, and is it the right portfolio for your goals, for your risk tolerance and for you based on where you are in your life. So for those clients that are ideal potential clients, we go through this step by step, looking at every single holding. What I think is really interesting, a good number of those people, when they present their portfolio to say, hey, take a look at this, they often say, I'm a little bit more conservative. But when we look at their portfolio and look at everything together, we often are shocked. They're actually not conservative. In fact, many times what they've done is they've invested exclusively in US stocks. And they feel that they're taking less risk by doing that, when in reality, they're taking on more risk because they're not investing in a globally diversified portfolio. And when I say globally diversified portfolio, what I'm essentially saying is that you have US stocks, but you also have emerging market stocks, as well as developed international. And Avni nailed it. She nailed it on the head. If you had not been part of the emerging market stock segment this last quarter, you would have missed out on a 10% growth, right? How smart is that? So don't take too much risk. Know and check what is the actual risk in your portfolio. And one of the best ways to do that is to do a full analysis. And we can look at the Sharpe ratio compared to other portfolios to make sure that you're not much more risky, not a lot more risky than you actually really are. The next one is anchoring. Anchoring is something that we see over and over and over. So a good example of anchoring is, let's say we have stock XYZ, and over the last year, it moved from $25 all the way up to $80. But then it had a drop. It dropped to $40. And what we've seen is a good number of people going in and buying at $40. They're bargain hunting. What those people have done is they've anchored in their mind that the value of this stock is $80 and now it's only selling at $40. It sounds like a good thing, but anchoring can hurt you because in this case, XYZ stock, the reason why it dropped in half of the value is that they actually lost their largest customer. This customer was responsible for 50% of their revenues. So now, is XYZ stock really should be valued at $80? No, maybe $40 is actually the right value. So the reason why I share this is that we've seen this with certain stocks. GE is a perfect example. Back in December 2000, GE was trading at a heady $55. And so many people anchored to that value of GE, blue chip company, value should be $55 a share. Now, back in 2000, we then started to see a slow march forward. And that slow march forward included the stock price going down and down and down until today, it's not even valued at $10 a share. Unfortunately, though, we've seen individuals hold on to their GE stock for 5, 10, 20 years or more. And what they've done is they've anchored in their mind that GE was once $55. It's valued at $55. So if I just keep what I have now, and heck, since it's gone down, let me buy some more of this stock, then eventually it will come back. So why I say this to you is make sure that when you are looking at your investments, that you look at all of the available data out there, not just the stock price of where it was a year ago or even 10 years and where it is today, but a better understanding of the fundamentals of that investment and whether or not it truly is a good value. And even more importantly, is it a good investment for you? So anchoring also to watch out for. So far we've gone through 3 different areas. We've talked a little bit about protecting ourselves from impulse decisions with our investing. We talked about taking on additional risks that we really can't can't deal with, that we can't take on those risks and put our financial future in jeopardy. Then we just talked a little bit more about anchoring. Now I've got two more. This is the one that I love the most, overreacting to the media. And this is a hard one. In fact, I try not to watch the news. Now, there are other places where I get my data of staying up with the market, staying up with the economy, but I try to be very vigilant on the actual sources that I receive this information, because it's understandable that if you watch CNBC, if you watch CNN, if you just watch whatever news station, local station is on, there is a lot of bad news out there. And the best way that they can sell advertising and get eyeballs to glue onto the screen is actually showing news that invokes anxiety, concern, worry, and stress. So this is a perfect example, the show, I don't know if you've watched Cramer. So Jim Cramer came out of Goldman Sachs, and he is on this show. It's called the Cramer Effect. And boy, he has it nailed in getting people to watch his show. The first thing is that there's lots of lights, flashes, animal sounds, sirens. He really talks about the short term, like we should do today. There's also never a panel or debate about Jim's opinions. It's always just what Jim says is right, which I would believe that he is extremely overconfident. And what we've seen is that had you invested in the investments that Jim Cramer has recommended in the past, you would have greatly underperformed the overall market, the overall S&P 500. So there's a lot of pieces of why this type of show becomes something that can really have an impact on you. And a lot of news programs also use some of these same strategies and techniques to essentially glue your eyes to their screen so that they have higher profits to be able to post in revenue because they have more eyeballs and can charge larger prices to advertisers. So what I say about this is just be smart. Be smart about where you're getting your information. And I know I do this, and I find a couple good websites that have very balanced information so that I'm making good decisions and not being swayed by overreacting to the market. All right, number 5. This is our last one here, herding. It's a herd thing. And, you know, this is something that I'm sure is not new to you. But the perfect example is, you know, I had lunch with my friend, and he sold all of his investments in international stocks and put them in cash. I think I'm going to do the same thing. Somehow, when we see other people doing something, we believe that if we're not doing that same action, that we're in the wrong. And so what I would say to you, again, is to be careful, because a perfect example was Bitcoin. In fact, this happened, as you know, not too long ago. In December 2017, Bitcoin reached an all-time high of almost 20,000 per Bitcoin, and we saw vast amount of money being funneled into Bitcoin. Now, where we're trading, you know, essentially 2 years later, or not quite 2 years, a little over a year later, we're now trading at only about $5,000. So you can see that Bitcoin has dropped by about 75%. This again was kind of the herding mentality, almost like the FOMO, the fear of missing out. So, you know, everybody's doing this, I need to do this too. Know that that is not necessarily the right thing. In fact, here's your solutions. We call these behavioral coaching, and it's really kind of fun, the 3 Ps. What keeps me on the straight and narrow is having a plan. I have to tell you, I love to plan. In fact, I find the whole planning process, whether I'm planning a vacation, I'm planning and writing out my financial plan, I find it very relaxing and comforting, because at least I have a guide. book, a guidebook to follow. And for you, the guidebook that you would be looking at from the financial perspective is having an investment policy statement that really marks out what your goals, your values are, how your portfolio should behave in good times and bad times, what the mixture of stocks and bonds should be, and how they might deviate from time to time. And also a financial plan. A financial plan for me gives me absolute peace of mind, and it allows me to look at my investments and match it to the financial plan to make sure that I'm on track, just as we do for all of our clients. So no matter what's happening in the market, our clients don't necessarily have to worry. Instead, what we look at for them is, how does this support their financial plan? Does it allow them to retire when they want to, buy that second home, travel, and have their money last out till age 95? So number one thing you can do, which is really easy, is making sure that you have your plan in place. And then being proactive. I think with investing, there is a lot of fear and lack of information. And so when you talk about investing, women in particular, and men, but I do find more so from women, tend to be more intimidated. And it's partially because, well, we just haven't ever really had a class in investing or a course. It's usually just not something that's even been talked about among the way we were raised and from our families. So understandably, if you don't really know much about it, it can be pretty overwhelming and quite frightening. In fact, I liken it to a race I did last year. I signed up for a half Ironman, and what that is it's a 70.3 mile race, and it's a 56-mile bike, a 1.2 mile swim, and then a 13-mile run. And I signed up because my brother signed up, and kind of peer pressured of, okay, my brother's doing this, he wants me to do it. Well, in the end, I have to say that I got over my fear. I was scared stiff about this race, but the more that I studied, the more that I learned about the training program, the more of the training program that I actually did. It was one of the best days of my life, and I've already signed up for another one. So something that was so frightening and scary to me, I actually am looking forward to, and it's such an accomplishment, and it's the same thing with investing. So continuing to educate yourself, continuing to learn, continuing to push yourself outside of your normal comfort zone, and get savvy about a topic that maybe in the past you didn't feel like you had a whole lot of confidence to become so savvy in. Because us as women and men, we are good investors if we follow these P's. So let me go to the third P. We just talked a little bit about the first P, which we talked specifically focusing on planning, and then being proactive in learning. And then the final piece is positivity. Stay positive. And this is really important because in reality, the market goes up 3 out of every 4 years, right? Look up in the sky. It's a bird, it's a plane. No, it's the S&P 500. And actually 3 out of 4 years, you are going to be right. And so being positive is really important and key too. There will be down times. There will be down periods. And actually, that's healthy. You don't want the market to be bubbling over and overinflated. You do need pullbacks. It's very healthy, just as we have spring, summer, and fall, and then we have the winter, right? You have that really cold weather where a lot of grasses die or at least go into hibernation for that winter time period. But then spring comes and everything is back, and that's the natural cycle of life, where you have growth for 3 months, for 3 seasons of the year, and then in one season you have stagnation, and sometimes even certain plants don't make it through the winter. But again, just looking at it from that, this is healthy. It's a cycle, and it's the same cycle for the market. Because perseverance has a huge amount of reward. This is a chart, and I'm just going to quickly describe it because I know there's a lot of numbers. But assuming that right after March 9th, 2019, March 9th, 2009, right after the bubble bursting in 2008. Let's say you had it and you decided to go 100% to cash. And you can see this line in this dark teal that had you done that, you would still have losses today equaling almost 30%. However, those that went to bonds, they were able to make up a little bit, about a 2% gain that they've had over those many years. But here are the winners. The smart investors were the ones that kept their portfolio at that 50% stock, 50% bond allocation. And for them, their returns since that March 2009 time period, up almost 100%. Look at that, 93%. So you tell me what is the better thing to do. It's being positive, it's being optimistic. It's knowing that there are going to be years where you have down periods, but that you stay the course and then you reap the wonderful benefits of the years, the majority of the years where the market's doing really well. So this is important. You don't have to do it on your own. This is kind of funny. This person's begging handled all of my own investments, kind of makes light of a situation that actually is not so nice to know. But you can see over 20 years, the S&P 500 had about an 8% return. The average investor, a little over 4%. So, you know, ultimately what it means is that the average investor typically underperforms because of all of these bias that I had talked to you about. So what you can do is you can focus on what you can control. You can control using tax-efficient investment. You can control investing in the lowest cost way possible. You can control being diversified between stocks, bonds, as well as international. And you can control whether or not you're able to stay disciplined. And the right investment philosophy is one that is not based on emotion. It's a philosophy that is based on evidence. And that's actually what we use as our key driver for all of the investment decisions that we make that are rooted in academic research. They are emotion-free, proven investment portfolios rooted in academic research, coming a lot of it out of the Chicago Booth School of Business. We know that your investment portfolio is a part of the picture. It's really the foundation, and it's what drives your financial security. It what drives your financial plan for working. And so with that, we want to make sure that your portfolio is always well allocated, that beautiful mixture between stocks and bonds. And know when times get scary, the longer you stay invested, the smaller the chance you have of losing money in the markets. And so this should give you great comfort because even if you're in your 60s, you're still looking at an investment horizon out to age 95. So that's another 35 years. So for all of us, pretty much all of us, we have really significantly long investment horizons. And so letting the market work for you is key. I'm going to end with a few more, just one more quote from Mark Twain. I really like this one. And essentially what Mark Twain said is he said, I've lived through some terrible things in my life, some of which actually happened. For many of us, our imaginations tend to go to negative places. And I have to say, don't let it. Because studies have shown 99 out of the 100 things that we actually worry about don't happen. And the one thing that does happen are often it's something that we didn't even think about worrying about, something that we didn't even imagine would be part of our life, of us having to deal with it. So I know, to be honest, I'm working on this of making sure that I don't get overly nervous about significant things I can't control, and to, again, go back to the things I can control. If you are unsure about your portfolio, if you're allocated the right way, reach out to us for our second opinion service. For qualified potential clients, we will create a personalized analysis of your current situation, every single investment holding, down to its fundamentals, its earnings, its risk, its cost, and how it all works together in each one of your accounts. So reach out to us, and you can give us a call at the office, 212-374-9008, or you can email info@francisfinancial.com, or myself or Avni. So please do reach out, because 80% of individuals say that they would love a second opinion on their investment portfolio. Who doesn't get a second opinion from another doctor before they go under major surgery? Well, your investments are really darn important too, so you should at least have a second opinion to make sure that you are on track. We have an award-winning team, very excited. In fact, wanted to let you know about a recent award that we just got last week, and that is the top 10 financial advisors here in New York. So very proud about that award. As you can see, many others here as far as top wealth advisor for moms. We're really doing what we love, and because we do what we love, we do a good job. And so I hope that you give us a call and reach out to us. We have great information for you. We want to support you and make sure that you're living your best life possible. Thank you.